Sivaram, the veteran investor and, of course, investment director at Enam Holdings. Sridhar, hi, good to have you with us.
Thank you.
What do you make of this? First of all, is this a bit of a near-term bear market, and how would we get out of this?
So this is a bear market. So first of all the the bulls who argue that this is a correction in a bull market, I've never seen a bull market which doesn't combine itself with earnings growth. I'm yet to see earnings growth in the last 18 months, and every time we talk about earnings growth, the whole hope of earnings growth is pushed to the next 18 months. So if this is a bull market, then this is the first in my history of 20 years that I have seen where we have a bull market without earnings growth. So I don't think this is a bull market by any stretch of imagination. We did get a cyclical pop because of elections in 2014. And I think a lot of the hopes have faded over the last 12 to, I would say in the last 6 to 12 months, where earnings have continuously disappointed. So I would say that we are clearly in a bear market. The asset class itself is facing a bear market. So let's look at the emerging markets. They are going through a bear market. India was sort of insulated from that for the last 12 to 18 months. But if we are having a bear market in the asset class, it's very difficult to see that one of the subcomponents will have a bull market independent of what's happening to the asset class in and around it. So I think this is a bear market. Whichever way you want to talk about it, it's fine.
Okay. Well, ACC numbers, and that clearly is indicating continued pain, at least at the revenue level for this cement company. Volumes were not too bad. Volumes, in fact, came in slightly higher at 6 million tons compared to 5.7 million tons. But even at the EBITDA level, we are continuing to see disappointment in ACC numbers as well. Sridhar, to come back to the global and the Indian scenario, therefore, your unambiguous comment is therefore that this is a bear market. We mistook it to be a bull market. We misread the growth signals.
Yeah, exactly. So if for whatever reason we were hoping that because of a new government, because of falling commodity prices, India will benefit. Yes, India has benefited. India has been one of the best performing markets within emerging markets. But we haven't seen the follow through, which is the earnings growth. And there are a combination of factors because of which earnings growth hasn't followed through in the last 18 months. And now we are seeing the correction. So it's a bit delayed. But I think this correction was overdue because we were basically a hope trade which was continuing for the last 18 months. And now the fact that even globally the headwinds are against risk appetite right now. Emerging market as an asset class is getting questioned. And India is the largest overweight within emerging markets. We haven't seen any selling at all. So if this happens, we will see some bit of selling coming from emerging market funds who are heavily overweighted India, and some bit of rebalancing will happen, and we'll have to face the brunt, especially like what we are seeing in financials. Financials is the largest overweight within the overweight India, and we are seeing huge selling in that.
Sridhar, what has changed in 1 year? 1.5 years. We had all-time highs in January last year. For the Bank Nifty also, we had all-time highs somewhere around Jan to March. And from that point, it's been one-way slide. We haven't even seen 1 or 2 attempts of decent rally. I mean, the rallies have lasted 5 or 6%. That's it.
So I think this has been a period which has coincided with a bear market for emerging markets. So let's not forget what's happened to, say, the large markets like Brazil, Russia, the currency that has devalued in all these markets. We have sort of been insulated. So during this period of carnage, a lot of money has flown into India because India was seen as a safe haven. India was a beneficiary of lower commodity prices. But these are good theoretically up to one point of time. After, say, 12, 18 months, people start looking at earnings growth. And let's face it, I mean, the earnings growth that we are seeing for this quarter, the earnings growth that we have seen in the previous quarter, and even what is expected of the next few quarters, they're not looking that great. So I think some sort of, I would say, balancing of it's a reality check, I would say, that, hey, this is not really working out to the plans. And maybe some of the FIIs are now redeeming. We're already seeing that negative FII flows over the last, 3-4 months. I think that may continue. India is at risk because, as I said earlier, India is the largest. So as per the Citigroup study, India's average overweight is more than 750 basis points. India's weight is only 7%, which means funds are more than 14.5% in the global emerging markets. That's a significantly large overweight to have in a single country. I haven't seen such large overweights in India for a very long time. So I think this is a consensus trade, and there's a huge risk that this may unwind if we don't have improved, economics and financials combined together.
Okay, what is your what are your bets in terms of growth? You've seen a better part of the earnings in the third quarter. Are the proverbial green shoots there? For instance, in a Britannia, in a Marico, we saw it in some of the consumer durable companies as well.
Yeah, so I think there are green shoots, and there have been green shoots in the last 6 months. They haven't followed through in terms of being an actual growth. The green shoots continue to be green shoots for the last 12 months. So we are seeing some green shoots even now. I think the biggest disappointment is consumption in general. If you look at the aggregate basket, not just say one company or two companies, you look at the volume growth for the FMCG companies on an aggregate, or you look at, say, even consumer durables. Those are quite disappointing. I mean, not even talking about financials where we have seen huge disappointment. So large part of the market is facing huge headwinds. Commodities, I don't need to say, it is well documented. IT is facing huge challenges because it is external oriented. So the hiding pharmaceutical, which is the other one, which is facing its own challenges because of FDA issues. So the hiding places are reducing by the day. So the number of sectors that you can hide has substantially come down. These are typical signs of a bear market where you're finding headwinds in most sectors. I mean, in a bull market, there's earnings growth in every sector, and you can then argue what is the right PE, because you tend to pay a higher PE during bull markets. Here we are paying a higher PE without growth. That is difficult to digest. I mean, this has never happened before, and these sort of corrections will happen.
Sridhar, I can tell you one thing. You are the first one who's saying it openly that this is a bear market. You know, so far, all we have heard is that this is a bull market correction. We have Sridhar Sivaram saying for the first time, perhaps, that this actually is a bear market. I mean, if it looks like a bear market, and probably is a bear market.
Okay.
Normally in bear markets, you hide in pharma, you hide in IT. This time, even that's not worked.
Yeah, so the places for hiding this time has been far and few, and I think it's more stock specific this time. So this actually reminds me of my early days in the market, 94 to 99. We had a bear market for almost 5 years, and the best of earnings never used to give any returns in the market. This reminds me more of that phase where the economy is going through a sluggish phase. Globally also nothing much was happening. There were more headwinds than tailwinds. And there were stock specific returns which you were getting. So it was more a stock pickers market, but it was a very difficult market. I mean, the best of stock pickers have struggled during that period. I think we are very similar to that phase where we've had that good phase in 14 and some part in 15 also. But all of them came with very poor earnings growth. There were mostly, it was, I would say, PE re-rating which happened. Now I think many of that, a lot of that will unwind as we go forward. And stocks which have strong earnings growth may continue to trade at a premium, which is what will happen. So this won't be a sector hiding place. It'll be more like a stock hiding place where you try to protect capital.
Okay, that exactly was my question. What kind of average losses do you still expect in the market? I'm not asking you to quote an index number, but
it's very tough to predict where the market goes, what percentage. I would say this is time to protect capital. I won't even say this time to bottom fish. I would say you should tread very carefully in this market. Global headwinds are very strong. We have to wait for the budget to see. I mean, my fear is that this budget may not be that great. There's already some sort of hints that some long-term capital gains may come back in some form. Those are really disasters for the market. If we see any such disasters, this market could go easily down another 10%. Currency could, depreciate. I think these are times to be, very cautious in the market. If you want to bottom fish, then you be very sure that you know the numbers. It's not a hearsay. So I'm still very cautious. I was cautious even last April, if you remember. But I was saying that the earnings numbers are not coming and the markets were moving. And I was wrong because the markets continue to move up. But the point is that earnings never came and then now it is correcting. I'm saying that if the earnings come back, so markets are slaves of earnings. If earnings come back, this market, you will start to move up again.
Move to gilts.
No, so for the moment you protect capital. You can figure out wherever you want to go. I'm not an asset allocation expert, but equity looks like a very difficult place right now.
Oh, it clearly is. Capital preservation is the theme, Sridhar, but how high is the risk of this long-term capital gains coming back? And theoretically, how negative would it be for market?
So one, the PM has spoken about this. So this is not some information that I'm giving from thin air. I have had some interactions with some bureaucrats in the government. It seems most of them are saying that this is a discussion paper right now, but I don't think the PM will speak about something if it is just a discussion paper. So in some form or the other, there is some contemplation of long-term capital gains coming back. If this comes back, I think this is a serious threat to the Indian market because one, this affects the domestic investor directly because most of the foreign investors, at least 60% of the foreign investors come through a tax treaty, either through Mauritius or Singapore. They may not get affected. This will affect the domestic investor, and we have just recently seen domestic investors coming back to the market. I think this will completely stop the domestic investor coming back to the market. The other thing, as I said, FIs are large overweight in India. Not all of them come through Mauritius. So we will see some bit of selling coming from there. I can easily see a 10% correction in the market if a long-term capital gains is introduced in this budget. If at all they have to introduce this, this is really a wrong time to do it. This is not a conducive market either globally or within India to introduce something. And I think the point that some of these bureaucrats miss is that today the government collects 6,000 crores in STT. Somehow this slips their mind. So when the PM talks about, that capital gains is free and the 1% rich population is benefiting from this, but hey, 6,000 crores collection from STT, this was in lieu of long-term capital gains. So I don't think the thinking of the bureaucrats as far as the long-term capital gains is correct, or they have not given all the data to the Prime Minister. It'll be very unfortunate if we get this in such a bad market. And what are they going to collect out of this? Maybe 2,000 crores extra. It's really a rounding off error for the collateral damage that this will have for the stock market, for the currency, for the fiscal deficit, for the current account deficit. I think this is really a very bad idea.
Okay, so this is the extreme fear. You could be losing anyway because there is a roiling bear market with earnings simply not supporting the kind of expectations. And if on this something as drastic as imposing long-term capital gains tax on equity sales is introduced in the budget, it could be a one-day 10% cut. That's, well, adding to the fear, but it's putting it in the right perspective. If you're making 3,000 crores from that tax and you're losing an opportunity to divest 50,000 crores, I think the government should get its math right. For the moment, however, the fear factor will persist. That's the verdict from this discussion. Thank you for joining us on The Markets, The Fear Factor.